next guy is just incredible. I'm so happy we have him here today.
I am too. It is my pleasure to introduce Stephen Bigalow with the Candlestick Forum. He has 40 plus years of investment experience, including 8 years as a stockbroker with major Wall Street firms. He holds his business and economics degree from Cornell University and is the author of 3 top investing books that teach trading with candlestick patterns. And I will share a short little personal story. Many years ago, when I was trying to learn how to read charts and price direction, I met Steve as he was teaching candlestick patterns. And I believe it was nearly 15 years ago, and I had tried, I don't know how many methods to try to understand price direction. And finally, when I attended one of his classes, it's like, I can see it. Finally, the candlestick signals, it's like a light went on. And so I just stopped him for the next year. Hey, Steve.
And the adjunct to this story was that after one of our sessions, Pat's husband, Eric, called me and said, I hate you. And I said, well, that's good news. Why is that? He says, because I haven't seen my wife for nights now. She stays up until 2 and 3 o'clock in the morning, look at candlestick charts, and I go to bed by myself, and I haven't seen her for weeks. So anyways.
It's true, though. I was fascinated because 15 years ago, we still were doing a lot of drawing, and, it just looked like chicken scratch to me. It made entirely no sense. And my husband, Eric, would go, well, can't you see this? I'm like, no, no way. I could not. So it was a huge, huge win for me. And I did. I got so excited that I finally understood it that, I got kind of addicted to it. So Steve, I am excited because today you're going to show other people exactly how to profit from elections using candlestick patterns, how the analysis shows the impact of major events, which sectors and stocks to watch if Biden wins, and will a Trump win have a bullish impact on general market? So I see you hedged your bets there.
All right. So I guess, Raleigh, if you could ask a question, I want to see, just take a percentage of how many people have seen my presentations before on candlesticks. That'll give me a gauge of how descriptive I need to be on each chart.
Okay, folks. So how many people have heard Steve before? Come on, guys, wake up. Give me some feedback. Not me, not me, not me.
All right. So
I have, not me, not me. Yes, I have. Love his jokes. Okay. Yes, yes, yes. It looks like about 50-50 between have seen you before and you are new to them.
Okay. All right.
Wait a minute. Somebody says he's the best. All right. There you go. On that note.
Okay. So I guess you can see the screen. Winning candidates, which are the winning trades? Now, I've got to hedge that because the assumptions are that if Biden won, probably the green energy stocks would be good. The banks would be bad because if he was raising taxes, that would knock the banks down. If Trump wins, the oil stocks would be good. But here is the benefit we have with candlestick analysis. And I say benefit with candlestick analysis is before candlesticks came along, I was the worst investor in the world. I was even a stockbroker for 8 years. And there's a good example of why when the public buys, that's time to sell. That's because there was stockbrokers that tell people when to buy and sell. So with assumptions, we can assume that if Biden won, things like Genco Solar was going to be acting well, and we could see that in the chart. Now, this is a chart that is very simple to understand if you're a candlestick investor. We had a fry pan bottom, and we could stay long as we stayed above this line. This is what we call the T line. Now, I'm going into this so that we understand what the strength of stocks and weaknesses of stocks were, looks like the Dow closed down 311 points today. All right. But as long as you see a buy signal, let me see if I can get to that. I'll get to the T line here in a minute. But remember all the assumptions that you people have. Sell in May and go away, or there's a Santa Claus rally. Those are always things that you kind of lean on, but the advantage we have with candlestick charts is the charts tell you exactly what is happening based upon investor sentiment. The Japanese rice traders always profess, let the market tell you what the market is doing. So candlestick analysis, for those that are new to my presentations, is the candlesticks are the graphic depiction of everybody that's buying and selling during a specific time frame. Now, a lot of people ask, well, do they work on the intraday or they work long term? Candlestick signals are the graphic depiction on any time frame. I used to trade the E-minis off a 1 minute, 3 minute, 10 minute chart combination. Currently, I trade intraday if I'm sitting here, soybeans or cattle or something like that off the 10-minute chart. As a swing trader, I'm using the daily charts as my my trade vehicle or my time frame. And people say, well, does it work for Forex? It works for any trading vehicle that has fear and greed. Whether you're buying stocks, bonds, currencies, commodities, tulip bulbs, anything that has fear and greed, candlestick signals are just a graphic depiction of what's going on in human nature. So when I was first learning candlesticks, the simple observations were the Japanese rice traders would point out where do most people buy or where do most people sell. Most people buy exuberantly at the top. So what turned me around from being the worst investor in the world to just constantly taking profits out is graphically, I could see when I was the one that was buying or I was the one that was selling. I said, well, I'm doing it absolutely wrong. I'll just change. So when I was learning candlesticks, I wanted to learn every signal. There's about 50 or 60 signals in the candlestick universe. But as I went back and analyzed charts, I discovered there was only 12 that you needed to learn, basically 6 longs and 6 shorts. Now, I wanted to learn every single one of them because back when I was learning, this was back in the 80s, maybe early 90s, I would try to find somebody that I could kind of confer with and maybe get a second opinion of whether I was analyzing things right. And there wasn't anybody around, so I learned everything. I tell people the only time I could get a second opinion was when I would go to the doctor. I'd say, what's wrong with me? And he'd go, you're fat. And I said, well, I think I want a second opinion. He goes, all right, you're ugly too. So I had to learn every single signal. But as I analyze the charts, I have narrowed it down so people don't have to spend a lot of mental time and energy trying to learn all 50 or 60 signals, where 90% of the time, probably 99% of the time, most of them won't show up. These will show up. So before we start on analyzing what would happen on a Biden win or a Trump win, or what was the market telling us, here is the most compelling indicator that you want to use ever. You've got all sorts of indicators out there, but the T line is the 8 exponential moving average, and it has Fibonacci characteristics, meaning it acts like a natural support and resistance level of human nature. So this is my most important screen on this whole presentation, because if you analyze that the candlestick signals are the graphic depiction of what is going on in investor sentiment, and the T line acts like a natural support and resistance level of human nature, when you combine those two, you've got an extremely powerful, high probability trading strategy. So with that, it's got very simple rules, what we call the T-line rule. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close back below the T line. Now, I'll make, let's see, I think I'll do it on this chart. The T line is the black line, a exponential moving average. I've got a little gray line in here that's the 34 EMA. That works relatively effectively. We also have the 50 and the 200 simple moving averages. We have those on here not because we're using them for analysis. We're using them because every major money manager around the world uses those moving averages to make their decisions about what's going on in makes their decisions about what they're going to do with their portfolio. We can see exactly what those investment decisions are at those levels. So a buy signal and a close above the T line, you can stay long until you see a candlestick sell signal. A candlestick sell signal and a close below the T line, you can stay short until you see a candlestick buy signal and a close back up above the T line. What this does is it takes your emotions out of your trading. I know there's a good number in here because I did it myself, that if I was ever lucky enough to have a profit in a position, which was rare before candlesticks came along for me, what was my biggest fear? My biggest fear was that I had a profit and that I would let it go back to be a loss. So what would I do? I would close out that position with a gain, but it might not be anywhere close to what the total gain could have been on that trade. So what do most people do? They buy, and if it goes down, they say, oh, I'm going to wait for it to come back to where I bought it. And it keeps going down, keeps going down, keeps going down. They finally can't stand the pain anymore, and they close it out. On the other hand, if they buy something and it goes up, their fear is it will go back to be a loss, and they sell it quickly. That's called eating like a bird and pooping like an elephant. What candlestick analysis does is it makes it very simple. You can sleep well at night that if you're in a position, as long as it stays below the T line, you can stay short, or if as long as it stays above the T line, you can stay long. So anytime I see a trade situation, I know that I can stay long until there's that major change of investor sentiment with a sell signal and a close below the T line. It's time to get out of that trade. So with that, if you just use those two truisms, that if you see a candlestick sell signal and a close below the T line, you have an extremely high probability a downtrend is being confirmed. If you see a candlestick buy signal and a close above the T line, you've got an extremely high probability that an uptrend is being confirmed. There's a caveat to that, and this kind of works in conjunction with what the Japanese rice traders tell us about human nature. Where do most people sell? They panic sell at the bottom. Now, why do we start looking for reversals down here? Because the further away you move from the T line, the higher the probability it's going to come back up and test it. So if we see a reversal signal, we now at least know where our first target is. Or if we're long and it starts seeing this exuberant buying in the overbought condition, and my overbought and oversold conditions are using stochastics of 12.33. If you're above 80 on the stochastics, you're in the overbought area. If you're below 20, you're in the oversold. So simple logic. And again, everything that you'll analyze in candlestick analysis is just common sense logic about what happens in human nature. Where do most people buy? They start buying exuberantly at the top. How do we see that it's exuberance? Well, obviously the candlestick formations get big up here in the overbought area, and look how far away we've moved from the T line. Now we see sell signals. There's out of the 12 major signals, the doji is probably the most recognized. It looks like a little cross, but there's a simple rule of the doji. The price will usually move in the direction of how they open after a doji. So if we're long, we're long, we're long. We see doji, and it opens lower the next day. We close out the position because where is the first logical target? Back to the T line. We did this with Tesla not too long in our options trading room. people would say, well, should we get out here? Should we get out here? And the answer was no, you stay long as it stays above the T line. Now look what was happening. Gap up, big move. Now look what was happening. We are moving way away from the T line, exuberantly away from the T line. Again, where do most people buy? They buy exuberantly at the top. We were getting out up here, even though it hadn't done a sell signal, because what was our alert? The fact we were that far away from the T line. And what did we do? We just simply moved to our 10-minute chart. And when the 10-minute chart showed us that there was selling started, that's when we took our profits. So the benefit we have with candlestick analysis is we know that it is going to move based upon what investor sentiment is telling us. The first basic analysis of price movement is prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. Raleigh or Pat, if you see questions coming in, don't be afraid to throw them in here so we can take care of them pretty close to the chart that we're looking at.
Will do.
Sounds
Okay.
good.
And so everybody, if you have questions, don't be afraid to ask. So sector analysis. Now we had kind of a convoluted, what do I want to say, reaction to the election, because there wasn't a, what do I say, confirmed winner. It's still in litigation and all sorts of mess. So what does that tell us? Doesn't tell us too much of anything. However, the day after the election, a vaccine announcement came out, and that blasted a lot of sectors. Obviously, the regional airlines could be analyzed on their charts that this was being benefited by a vaccine. So unfortunately, my whole dissertation here that's supposed to be on what's going to happen based upon a Biden win or a Trump win was overshadowed by the fact that there was no real winner, and we had the vaccine announcement that took a lot of stocks and moved them dramatically. Now, this goes back to a very simple statement. You let the market tell you what the market is doing. I would not have any idea which sectors might be moving better than the others, because if I sat here, I couldn't come up with things and say, well, which sectors are going to move if Biden wins, and there's the obvious ones. But I wouldn't have guessed that pollution and treatment would be acting strong. This is why the simple analysis of buy signals and strength coming into a sector tells me now I can pinpoint which stocks to look for. So this is a very simple process. If we see the pollution and treatment sector acting strong, what's our assumption? That stocks in that sector are acting strong. We can, here's a big fry pan bottom. This is one of the 12 made, or one of the patterns that you can recognize in candlestick analysis. The reason you can recognize it is very simple. Human nature works the same way time after time. The patterns are all recreation of the reoccurring investor sentiment that occurred time and again. And so there's a fry pan bottom on Aqua. Mid jumped pretty strong. And ERII also jumped back up. So what this basically told us, or what this basically does for us, or me anyways, is I don't have to figure out which sectors might be moving because of a certain situation. The charts are going to show me that. And that's also because I can sit here and think one thing should be happening, which most investors try to do. And in my case, I was usually wrong. That's because I was like most investors. So when you go back and say, well, let the chart tell me what people are thinking, now you have much better insight as to what was the thinking of something happening, of maybe not just the obvious, but somebody thinking 1 or 2 steps ahead. Whoops. So oil and gas refining, for whatever reason, took off. Now, I wouldn't have guessed that based upon a non-election result. But the fact that the vaccine announcement came out told us, oh, maybe we're going to be traveling again, driving again. And so they took off. So I could go and find out which stocks in that sector were taking off and putting me in the right positions at the right time. We also recommended doing Reggie not too long ago, or last few days. This is what we call convergence analysis. Convergence analysis is when you can look at a chart and see a buy signal and confirming indicators. But if you can also see other factors, meaning additional factors that would confirm the buying, such as a morning star signal, one of the 12 major signals, bouncing right off the 50, closing back up above the T-line, and then this is what we call a bullish flutter kicker signal. A kicker signal is your strongest candlestick signal. It's where they open here and close here. The next day they gap up and go the opposite direction. Well, in this case, they gapped up above the previous day's open and did a doji. Now, remember what we just said about the doji rule. The price will usually move in the direction of how they open after a doji. So if it opens positive with stochastics coming up, there's a good probability, extremely high probability, it's going to trade positive. Why do we call this a bullish flutter kicker signal? Because if you took this little flutter out, you basically have a kicker signal, which is one of your strongest signals. Whoops. Oh, that was supposed to be better. So this was supposed to be a rhetorical question. Was the election results affecting the markets? And the answer was no, it's vaccine. Oh, there it is. The election results haven't done anything to really stimulate the market one way or the other. It's been the vaccine that has created the big results. So on things like ICPT, it took off like a rocket.
Steve?
And yes.
So we can let people stay up with you. What is the green line? So just repeat the green line there.
This little green line?
Yes.
Is the 3T line. Okay. Now the 3T line acts in conjunction with the T line. And it works 2 ways. One, it acts as a little additional confirmation if you see a buy signal and the 3T line crosses. And 2, if you're moving too far away from the T line, then the 3T line becomes a more effective reversal indicator if you see a sell signal and it come back down through that level. If it does that, that means they're coming back to the T line. Go ahead.
The gray moving average?
The gray is a 34 EMA. Now, the nice thing about candlestick charts is we know that the top priority for analyzing anything in investor sentiment is the signal itself. Everything else is a confirming indicator. So as you can see, the charts aren't real junky. Got very few indicators on it. And basically it's because the signals are your top criteria. So I put the 34 EMA on there because it works reasonably well. Now, the true fact of the matter is I could take everything off this chart except for the signals themselves and the T line, and I could trade very effectively. Or the signals and the T line and stochastics. That alone would be give you extremely high probabilities you're in the right trade at the right time. Everything else can be added as a confirming indicator. So if somebody says, oh, you might want to add the XYZ indicator, well, if you throw it on there and after a couple of weeks you see it doesn't work, you take it back off. If you throw something on there that kind of enhances the probabilities you're in the right trade, you just keep it there. All right, anything else?
Oh, I think we're good for now.
Yahoo. Okay. All right. So this one, this is again, convergence analysis. This is what we call a bullish or doji sandwich. A green candle, a doji. And again, what's our doji rule? It's going to move in the direction of how they open after a doji. So a positive open was going to tell us that this candle right here is probably going to be the same magnitude as this candle right here. So what's that analysis tell us? Stochastics coming up. If it's that magnitude candle after a positive open, it's going to close above the T line. What's that tell us? We can stay long as we stay above the T line. Where do we want to get out? When we see exuberant buying in the overbought condition, except when we can see that it's doing something that is altering the chart, such as if this is kind of a resistance level and they're gapping up through a resistance level, staying above the T line, what's that telling us? Well, it's telling us that everybody and their brother that watches resistance levels are buying. We're already in the position, or we're adding to our position, seeing that little gap up through the resistance level after buy signals, which tells us this resistance level isn't there anymore. Now we've got the probabilities of a good, strong price move. The restaurant stocks all acted well because obviously with a vaccine, everybody's going to get back out eating in the restaurants. Well, that was the news of a few days ago. And this is what we call a scoop pattern, another high probability pattern setup. You can see how there was buying going on here. Inverted hammer, a doji gap up, a doji gap up. As you can see, it's rounding as a bottom here. Now, we can break apart the whole pattern. This is an inverted hammer. It's kind of a reverse psychology. If the bears are happy, the bears are happy, the bears are happy. Whoops, there's some buying going on. The bears are getting a little bit nervous, but they're relieved that it closed near the low end of the trading range. The next day, the bulls step in again. The bears say, shoot, the bulls are here again. Get me out of this trade. Now, I point out this inverted hammer because it's one of the 12 major signals. It's probably the least frequent of the 12 major signals. But, and this is unofficial, this is my statistics of trading 40 years, that anytime I see an inverted hammer in the oversold area, followed by bullish confirmation the next day, you've got probably a 95% probability or greater that you're going to be in an uptrend. And here's another aspect of candlestick analysis. Because there are expectations following candlestick signals, make stop losses very simple. If I was buying this with a 98% expectation of trading positive, where would I not want to see it trade? I wouldn't want to see it trade back through this level. If it did, you close it out. This is the process that everybody preaches that says cut your losses short and let your profits run. In the 40 some odd years I've been trading, I've never heard a single one of them tell you how you cut your losses short and let your profits run. Candlestick analysis uses very simple logic to tell you when to stay in a trade and when to immediately get back out of a bad trade. Following that inverted hammer, this is a doji gap up. That's called your best friend. That's because it has two elements to it. One, it's called your best friend because the probabilities of being in an uptrend is extremely strong. And two, the magnitude of that uptrend is going to be extremely strong. So you got a best friend signal, setting up a scoop type pattern. This is the expectation, a slingshot effect up to the upside. So here's the T-line rule. And again, I used to being the worst investor in the world, when candlesticks came along, I was just happier than a pig in doo-doo. But I've finally found something that would put me in the right trade at the right time. And I was making decent money. But then when we were introduced to the T-line, adding that to the chart, that kept me from getting out of trades that might be a sell, but didn't confirm because it never closed below the T line. Now, the reason the T line is so effective for us is you will notice how often the T line acts as support on these trades. And the reason that is relevant is people aren't watching to see what it's going to do with the T line because nobody has the T line on their chart. I tell people when they pull back here, they're just pulling back on most people's charts just to an area and then coming back up. We have this indicator that tells us where the actual support level is. We're still holding on to NIO. NIO, I think, was up another $4 or $5 this afternoon. I would have probably closed this out a number of times and just watched it go on without me. But as long as it didn't close below the T line, you can hang on to this one. So that was the same logic over here, that if you had bought, not only was it not trading below the T line, they weren't even trading back below the 3T line. So if they're not even trading back below the 3T line, that tells you that bullish strength is there. And then where was the time to take profits? Look what happened up here. Look how far away you had moved from the T line in the overbought area. That's where you start going to your 10-minute chart. Now we're getting ready.
RSI?
Pardon me? Go ahead.
Someone had a question, if you'd explain the RSI.
Oh, it's not RSI. It is stochastics.
Right, they see RSI on your chart, so kind of show them below that.
Oh,
Mm-hmm.
I was just, yeah, you can use either RSI or stochastics, whatever is better. I threw this on for an illustration that no matter what you use, some people use RSI and some people use stochastics. Now, I've been using stochastics.
Okay.
The worst case scenario is you can put both of them on there. It's not like you're getting confused. You can see which one works more effectively.
Okay, and then I'm going to type into chat for everybody that the T line is the 8 EMA, correct?
Yes.
And the 3T line is the 24 EMA.
No, the 3T line is the 3 EMA.
3 EMA, okay.
Yep. The gray line is the 34 EMA, which works relatively effectively.
Okay.
And I say relatively effectively enough that it you can put it on your chart. It's not cluttering anything up, and it works reasonably well.
And Steve, Raleigh here, there was also a question that came in. I think you'll get to this a little bit later. Was wondering if this is good for day trading futures as well.
Yes. Remember, this candlestick analysis is the graphic depiction of everybody buying and selling during any time frame. As I mentioned before, I used to trade the E-minis off the 1 minute, 3 minute, 10-minute combination. So you can pick out any combination based upon the nature of your trading. If you're day trading, but you're only making maybe 2 or 3 trades during the day, maybe use a 10-minute, 15-minute, 30-minute combination. If you're trading pretty active, maybe use a 1 minute, 5 minute, 10-minute combination. So it works just as well on a 1 minute chart as it does on a monthly chart. As I mentioned before too, I trade soybeans, cattle, cotton, any of the commodities, but I usually trade off the 10-minute chart. I'll use the 10-minute chart as my bellwether, that if I see a candlestick buy signal occurring near the 10-minute chart, then I'll flip over to my 5-minute chart to see if the 5-minute chart is also forming buy signals or continuing in the same direction. So it's going to further enhance the 10-minute chart. And then if I get ready to pull the trigger, I'll flip down to the 1-minute chart to make sure the 1-minute chart is still moving in the same direction that was still going to perform or confirm the 5-minute and 10-minute chart. So you can trade any time frame. If you're a swing trader like myself, or my trades are usually 10 or 2 to 10 trading days, I'm going to trade off the daily chart. If you're more of a long-term holder, and in my case, a long-term hold is about 3 weeks, but let's say you want to hold on to things for a month, 2 months. You don't want to watch them every day. You might use the combination of the daily chart and the weekly chart to make sure the trend is still in effect. So the charts are what they call fractal, which means they work, all the indicators work just as effectively on a 1 minute chart as they do a monthly chart or anything in between. Okay, so with that, this is what the Dow did today. Now, remember a while ago, and this is what has turned my investing around, because if you remember what all the talking heads, all the experts said was going on, or things look bad, blah, blah, blah. But then we started seeing a doji hammer bouncing right off the 200-day moving average. So what did that tell us as candlestick investors? That told us that everybody was deciding to buy right off the 200 with stochastics in the oversold area. And when they opened up positive the next day, what was that telling us? That was confirming the doji and our doji rule. They were moving in the direction how they opened after a doji. They gapped it up. There's your best friend signal. That implied we were going to be in a strong trend. The next day when they took it through the T line, further confirmation we're going to be in a strong trend. Then we were getting up into the overbought area when they gapped it up because of the vaccine. That was great news for everybody, except we could see that they were selling by the end of the day. Even though the Dow was up 800 points, that might seem very bullish to a lot of people. We could see there was already selling going on. So right now, today, the market sold off 300 points. So where's the next logical target? With stochastics in the overbought area? Probably at least back here to the T line. What's that tell us about our positioning? We probably, definitely, if we have any longs that were looking weak, we were closing them out and we were adding to short positions. We can do the same analysis. So a lot of people ask, well, if you use the Dow, isn't that only 30 stocks? You can use the Dow, the NASDAQ, the S&P, and the transportation index. And you can analyze each one of those. And that's not a difficult process. You can probably analyze what is going on in each one of those charts total of 15 seconds. So if I see that the Dow is selling off, I can see we had a big bearish left-right combo. A left-right combo is a doji followed by a bearish engulfing signal. That is one of your strongest reversal signals. They took the NASDAQ right down here to the T line, tried to bounce it back up. Right now we can see that there is no bullish or bearish confirmation, but we're still in the effect of this big bearish engulfing signal. That would imply we want to be more oriented toward the short side than long side. So I keep telling people this is not rocket science. This is merely having the ability to recognize the signals. And not only did the Japanese race traders provide us the graphics of the signals, but they also told us what the results or why those signals are being formed, what the investor sentiment was that caused those signals. So if you can recognize a signal and you understand what caused them, now you have the same analytical grasp as somebody that's been trading in the market for 50 years. We had been short run because run was in a downtrend. And then this is what we call a blue ice failure. This was named by my late friend Dave Elliott of Wall Street Teachers. His philosophy or his explanation was they fell through the ice. Then they come back up and try to find the hole that they fell through. They fail, so they drown. Where are they going? They're going to the bottom of the pond. So we're short this one. Notice what even happened today. It gapped way up, and then for the rest of the day, it sold off. Our expectation is that and this also creates what we call a bearish J-hook pattern, which is one of the patterns. Bearish J-hook pattern is a downtrend, then a hook up, and then wave 3 is usually the same magnitude as wave 1. So that's added confirmation that we can be shorting this one again, because our expectation is they could take this all the way down to the 200-day moving average. Now, will it get there? We don't know, but the probabilities are that it's heading in this direction. And what is our criteria? Not for the target, but we stay short until we see a candlestick buy signal and a reversal. So all this is basically candlestick analysis is just investment common sense put into graphics. If we need to, we can go to some live charts, but before that, I guess we've got a special. And it's more oriented toward the T-line and some high profit trade setups. Now, the reason we can recognize high profit trade setups is because investor sentiment works the same way time after time. All we have to do is analyze what's going on in investor sentiment, which basically puts us in the right trades at the right time with a high degree of probability. Now, the word to stress there is probability. The reason we're looking at these patterns and signals is because over 400 years, the Japanese rice traders have illustrated what a signal looks like and what the expected probabilities are from that trade. So that gives you two dynamics that most trading strategies don't do for you, which is it tells you exactly when to get into a trade, how long to stay in the trade, or it tells you when you get into a trade and it doesn't work, it tells you shows you to get out immediately. Again, cutting your losses short so you can take those funds and move on to a trade that has better probabilities again. So this package is very descriptive of how to use the T-line. Again, the T-line is probably the most effective indicator that I've come across in all the years that I've been trading, and I've used every single indicator in my years to try to improve my trading. Very simple logic. If the candlestick signals tell you what's going on in investor sentiment, and the T-line acts as a natural support and resistance level of investor sentiment, when you combine the two, you get a very powerful combination. So we got this. I'm sorry. Oops, go ahead, Pat.
We put the link in chat, and are you able to do a screen share if we have any requests for you to review some charts?
Yes, let's see. Let's do this.
Why don't we do that?
Let's do this. All right. So here was our trade on, can you see the chart all right?
Not just yet. So let's make sure the screen share goes back.
Oops, screen share.
Yeah. And if everyone would put some requests in or additional questions while we have Steve, let's abuse them. Why not?
Poor Steve.
Yeah. So,
Okay. Did the screen share come up?
yes, we see it now. And
Okay.
if we get some chart requests coming over.
Okay. So again, going back to this improves our probabilities of being in the right trade at the right time. Recognize a pattern that you can see quite often. Let me throw up a couple.
Question about slow stochastics and moving averages. So John was asking, are all the moving averages slow or fast?
They're all slow.
And
why? It doesn't matter. We're not buying stochastics. What the logic is for stochastics, let me find something with much sharper movement. We're using stochastics to tell us where we are in the trend. So the logic is, if you see a candlestick buy signal in the overbought condition, it doesn't mean very much. If you see a candlestick sell signal in the oversold area, it doesn't mean anything. What we're looking for is a candlestick sell signal in the overbought condition or a candlestick buy signal in the oversold condition. So the stochastics are not anything that you have to be specific on. It's slow stochastics, and I used 1233. And the only reason I use 1233 is because when I first learned candlesticks back decades ago, the common stochastic number was 1455, but that was too slow for what I was doing, which was swing trading. So I just spent a night at a computer, which that was just about when candlestick charts came onto the computers, that I would set my stochastics based upon the peak and the valley. So I'd try 1432 or 1315 or all sorts of numbers. And 1233 was pretty close to what I needed that I've used for the last 40 years. So it doesn't matter whether this is fast stochastics, slow stochastics. You just want to find something that is kind of correlating to when you're seeing the buying and the selling.
So Steve, Raleigh here, another question has come in. How would you react to a situation where you're in a trade and the T-line does not react with your stochastic overbought condition? Is that a clear sign to get out of the trade?
With the T-line, read that again.
Sure. How would you react to a situation where you're in a trade and the T-line does not react with your stochastic overbought condition? Is that a clear sign to get out? I guess what we're talking is about a divergence there.
Yeah, there won't be a divergence. They have absolutely no correlation with each other. The stochastics are based upon a formula of high, low, open, and close, and the T-line is a function of what the price is actually doing.
So if you're there in the trade, and once again, you're basically letting the trade run. You're in the trade. It's in your favor. It's above the T-line. You're in the trade at that point in time. The things that would cause you to exit that trade would be a move below the T-line, essentially. You're not looking at the stochastics or the RSI to tell you when to exit.
Right. The stochastics only tell you where you are in the trend.
Yep.
The T-line tells you if you see a sell signal and a close below the T-line, you're already in the overbought condition. This is what's going to be the reaction to tell you it's time to close out that trade.
Excellent.
Well, I was sure we'd get some chart requests. Everybody's being shy.
All right. Well, let me throw on a few that are.
There we have one, NVDA.
Oh, NVIDIA. All right.
Mm-hmm.
So this is the way you can trade. Now, not only do you have the graphics of the signals and patterns, but you also have the graphics of which direction is this chart moving. Right now, we're not trading NVIDIA either long or short, only because it's sideways right now. So you'd be looking at very short-term time frames. The only chart that looked good in the what I call the biggies is Apple, because you do have a buy signal, a gap up, a breakout of this level, now another morning star signal. A morning star signal is a big down day. Usually a morning star signal should be occurring right here, but you have the same formation right here that implies that when they came back to the 50 and the T-line, there's the doji. There's the next bullish day that closed more than halfway up this candle that created the morning star signal. And so the market was off 300 some odd points today. And the Apple stayed up pretty strong. So that would imply there's a lot more strength in Apple than the other ones. The other ones, like the other biggies, like Amazon, you can see which direction this is moving. Absolutely sideways. So we wouldn't be trading this one at all. We have stocks like Overstock, that there's your bearish best friend. Remember, a bullish best friend tells you there's going to be a strong up move. A bearish best friend tells you the same thing. There's probably going to be a very strong downtrend. So if you're short this one, how long do you stay short? As long as it doesn't close back up above the T-line. Even though you're in the oversold area, this right here is your strong criteria. Again, this is based upon the strength of investor sentiment of whether you're heading down or heading up. And that added criteria is as long as you stay below the T line, you can stay short. We just went short on CYH because this is your big evening star signal. A big up day, a day of indecision. There's your shooting star, one of the 12 major signals, followed by a bearish candle. So this is all an evening star signal that closed right on the T line. Well, it opened today and traded positive. But as soon as it came back down through the open, what color was this candle showing you? Dark candle. What did that tell you about the bulls and the bears? It told you the bears are still in control. This is a good short. Your stochastics just rolled over. Where's our targets? Maybe here, maybe here. Or if you're watching to see what everybody else is watching, you could throw the Fibonacci retracement numbers on here, if I can do that. So there's one target, there's another target. So we don't use Fibonacci numbers, we don't use Bollinger Bands, but you can use whatever you know everybody else is watching because we'll be able to see what type of formation occurs when it gets to those levels. I'm trying to think of some more that were...
We had somebody came in and asked about AMD.
AMD has just been a sideways chart. This is one where we've been saying it wouldn't be long or short because there's no trend to it. So the whole point of candlestick analysis is we want to see when there's a definite change of investor sentiment. There's really no definite change of investor sentiment. It's moving sideways. We're trying to find the things. So right now, our advice is wouldn't be long or short. Your stochastics are basically sideways.
Sure.
And your price move is basically sideways. And for all you know, it's going to just waffle in this sideways mode. So where would we pay attention to this one? Probably after it broke out through this level to the upside.
So Steve, more people are typing stuff in. The ever popular Amazon.
I'll do that. But here's that bullish flutter kicker. Again, your strongest signal. And there's your doji. Now, this gives you a trading, platform or trading strategy. If this opens higher tomorrow, you've got a doji sandwich. And where's that doji sandwich occurring? Right here at the breakout level. If it opens lower, you close out the position because what's that tell you? You've now got a sell signal right here where it's topped out before you close out the position. It just provides a much easier or much more visual playing field for what to do at the appropriate time. You can see right now, Amazon, we're not long or short. We're not even trading any of the biggies right now because the market doesn't know what it wants to do and these big stocks don't know what they want to do. So you can go through all the biggies. When I call the biggies the ones that everybody's always touting or trading, Netflix, absolutely nothing. So when you have something like that, you've got sell signals, you know you have a downtrend. There's going to be times in all analysis that the charts or the candlestick signals tell you when to sell, when to buy, and when just to stay out of a trading vehicle.
Sure. Steve, guys just piped in and was just wondering, he notices that you don't basically, you're not putting volume on your charts. Is there a particular reason why you don't look at volume, or is everything you need right there in front of you there?
Everything's right there. And I tell people you're not trading volume. A lot of people say, well, I want to see the volume go up as the price goes up. If nobody's willing to sell the stock, the price is going to go up on small volume. The only time volume becomes a added little fluff is, let's say on a big reversal day or the day before or the day after, you see a volume spike. if you see a volume spike, then you can use that. I'll have to call you back. Sorry about that. I don't have a way to mute the darn phone. Oh, well, Shazam. Abe, I'll have to call you right back. Okay, sorry about that. All right. Yeah, I don't know where my secretary went. But yeah, so this is telling you it's not time to be buying this or trading this stock. It's just not going anywhere. The whole point of candlestick analysis is that every time you look at a chart, you can see where the probabilities are in your favor based upon the signals and patterns. In this case, we were ready to buy ICPT because remember, look what's happening here. If one doji means indecision, a series of dojis means greater indecision. This is what we call the cradle pattern. There's kind of the headboard, there's the bed, there's the footboard. It's usually going to create a strong price move with the cradle kind of hanging down between the trends. But this allows you to analyze something like this, allows you to project with greater probability of what the next price move is going to be.
And Steve, on that particular chart, we see the bar breaking above the T line there. Do you like to see it clear above that blue line as well?
No, the blue line is the 50-day moving average.
Okay, so that's not, you don't consider that major support and resistance.
No, this is what we're trading. We're trading the signal. This just becomes something to watch. Now, if this had come up the next day and then sold off and then traded lower, then we could assume that was acting as resistance. The fact that this was our signal or pattern breakout, again, notice it couldn't get up above the T line, indecision. This told you there was now a new dynamic in investor sentiment. The probabilities was going this way. The fact that they gapped it up above the next resistance level gave us more confidence that this is still going to be trading higher.
So we had another person just type in there. This is a great question. What is your favorite bullish candle signal?
The answer to that is they're all good. And the reason I say that is...
if you could only have one.
If I could only have one. Well, I'd have to put it in. I tell people there's about 18 signals and pattern combinations that we call top ranked signals and patterns.
Okay.
Now, that's a lot to learn. But I tell people if you just learn 3 or 4, and the 3 or 4 that I'd recommend would be the best friend signal. Darn, I wanted to show. Let's see if I can find. The best friend signal is that doji gap up. Well, here's a case. We're going to be doing a training session in a couple of weeks on what we call convergence analysis. And convergence analysis, again, is putting as many aspects into our bullish confirmation as possible. This is what we call a bobble breakout. That's a J-hook pattern that's more defined by resisting at the T line, at the 50, pulls back right to the T line, and then goes through. That's a bobble breakout. You can see that's a J-hook pattern with a more defined resistance level. And then where does it pull back? It pulls back. This is another element of human nature. If they break through a resistance level, they'll usually come back and test that level to see what's going to act as support. If it acts as support, everybody's confident that it's acting as support and they'll start buying. We could see the buying started with that hammer signal and a close back up above the T line. Now you've got another J-hook pattern. So what's the implication of this whole chart? There's still a lot more upside because you're getting a lot of buying and more than just one confirmation. Oh, I forgot which one you were...
No, the question, was, is there...
Oh, my favorite. Okay.
Yeah.
I'm sorry. Yes. So anything, there's your best friend signal, doji gap up. So if I was going to pick one, it would be the best friend signal, but I'd follow it right close behind with the left-right combo. That's a doji followed by a bullish engulfing signal and the kicker signal. and a fry pan bottom breakout. So if I was going to pick 4 out of the 18, I'd pick those 4. And just with those 4, with the simplicity of candlestick scans each day, you would have more trades than you'll ever be able to handle, which puts you in a position where if you've picked out 15 good trade setups for the next time frame that you want to trade, now you're in the position to cultivate those trades to see which ones are the best ones out of those. So you're constantly cultivating your portfolio to where you're putting in very strong probability trades. So that best friend signal followed by a J-hook pattern. What do we know should happen here? If it opens positive, we've got a doji sandwich telling us we're continuing higher.
Sure. And then if I'm, once again, in this trade, I'm just spitballing here, Steve, just a little bit. I could be using the T line to trail a stop potentially, something
Yes.
along those lines. Yep.
Yes. So if we've got a good trade going on, just use one simple rule. You stay long until you see a sell signal and a close back below the T line.
Mm-hmm.
So the T line has, as I said before, I was making good money when I first learned how to use candlesticks, but when I added the T line to my analysis, the probabilities are always so strong that you're in an uptrend as long as it doesn't close below the T line. It kept me from getting stopped out or saying, oh, I'm going to close here. It looks like a sell signal. I'll get back in if it goes back up. Well, usually I'm moving my money someplace else. Now I could comfortably just stay with it until we see that that sell signal. So if I was in something like this, I could just stay long, and I don't have that fear factor that, boy, I'd hate to have this turn into a loss. I can see exactly how long to stay in it and when to come back out of that trade.
Absolutely. Steve, one more here. We've had several people type in, and JMIA.
Oh, Jabaya. That one was one that we were long because of the fry pan bottom breakout. Look at your doji sandwich. What did the doji sandwich tell us at the 50? If it opened positive, what was it telling us about the 50? The 50 was not going to act as resistance. How long did we stay long? Until you started seeing sell signals, closed out, got back in because there was your J-hook pattern. But look what happened up here at the same level that it topped out before. This is a hanging man signal, one of the 12 major signals, and a harami, which tells you the buying had stopped. When it opened lower the next day, we closed out the position. Right now, we wouldn't be long or short because that's just now a nothing chart. I wouldn't be long or short this one. So a lot of people, and I say a lot of people because I used to do it myself, I'd say, oh man, I'm hoping this one will come back. I'm going to hang on to it and see if it comes back up. Instead of saying, this is not a good chart, let's close it out. If we're long, take our licks and go find a chart that look like this that has much greater probabilities of getting a positive trade result again.
Fantastic. Well, Steve, we've come to the end of the session here, and man, what a great session. I'm glad we had that opportunity to mix education with the live chart examples, because I think that just brought it together for everybody.
Well, good. All right. Well, thank you, everybody. Thank you, Pat. Thank you, Nikki. Thank you, Raleigh.
Oh,
and
you're
thank
welcome.
you, everybody, for showing up this afternoon.
Absolutely, Steve. Take care and have a great evening.
You too. Thank you.
Here we go. How's that?
All right.
Okay, so folks, once again, that was Stephen Bigalow with Candlestick Forum. Just always been just a significant personality in our industry for a number of years. And the special offer that he made available was, we call that the Triple T trading strategies. He's going to share techniques for timing the best trading entries, how to spot and profit from the T-line crunch setups, and how to trade the frying pan bottom and the slow curve for big gains. These are some of the key things that Steve uses on a regular basis as he trades the markets. And all you have to do there is go to westmarktrading.com/M11 bundle, and you'll be able to have access to and check that out. So, here we are now at the top of the hour, and it's time for another quiz. This is our next to last quiz of the session. And guys, the rules here is pretty straightforward. You just need to be the first person to answer the quiz question. And we do ask that if you have already won either today or yesterday, please give an opportunity for somebody else to have a shot at winning the quiz. So with that, the quiz question right now is, who is the only president to have been an officer on a submarine?
Peel, peel the banana, go.
What is that song?
I have no idea. It's
My daughter
going-
would like that. She loves bananas. We're still blocked from video. So
You're still blocked from video?
Uh-huh.
That's the most.
Okay, we've had several people come in here, and I see, do you guys have the feedback as to who the first winner was?
Let's see. Bill. Mr. Bill.
All right.
Congratulations.
And the answer to that question is Jimmy Carter. He graduated from the Naval Academy in 1946. He spent 7 years in active duty, primarily on submarines and a number of officer capabilities, positions. So Jimmy Carter, the man in the submarine.